October 19, 1987. It was supposed to be just another Monday on Wall Street. Instead, it became a day that would haunt the financial world for decades. In a single trading session, the Dow Jones collapsed by 22.6%, the largest one-day fall in history. No bombs, no scandals, no breaking news. Just the market, turning on itself. Traders screamed. Phones went dead. Billions evaporated before anyone could even understand what was happening. And when the smoke cleared, the most terrifying discovery wasn't why it happened, but how. Because the crash wasn't caused by human panic. It was caused by machines. Programs that were designed to protect investors ended up triggering a feedback loop of self-destruction. A system built to prevent risk created the biggest risk of all. And if you're watching this in 2025, that should terrify you, because that same system didn't disappear. It evolved. It got faster, smarter, and far more dangerous. And this time, it's not 10% of the market controlled by code. It's nearly all of it. The next crash won't come from fear or greed. It'll come from logic, from algorithms doing exactly what they were programmed to do, until everything breaks. Before we dive in, hit that subscribe button and tell me in the comments, do you really know what happens when your investments are just lines of code? Because what's coming next isn't human. The 1980s were a decade of confidence. Reaganomics had revived the American dream. The stock market was unstoppable. Tripling in just 5 years, Wall Street was a machine printing wealth, and everyone wanted in. Analysts called it a new paradigm. Computers were making trading faster, more efficient, and supposedly safer. It was the dawn of financial innovation, and one invention in particular promised to eliminate risk forever. It was called portfolio insurance. The idea was elegant. If the market started to fall, a computer program would automatically sell stocks and move money into safer assets like treasury bonds. No emotion, no hesitation, just pure mathematical discipline. Institutions loved it. By 1987, billions of dollars were tied to these programs, all running the same logic. If prices fall, sell. But on October 19, 1987, that simple line of code turned into a financial weapon. The day began quietly. The Dow opened slightly lower, nothing unusual. A few percentage points down after weeks of volatility. Then the computers triggered. Small dips turned into big ones. The programs began to dump shares, trying to protect portfolios. But that selling made prices fall faster, which triggered more programs to sell. And when everyone's machine was selling at the same time, there were no buyers left. It was a death spiral, a feedback loop so powerful it erased decades of human judgment in hours. By mid-morning, traders were panicking. The phones on the NYSE floor buzzed non-stop, but liquidity was gone. One broker later said it was like trying to sell into a black hole. Orders went unanswered. Prices fell through the floor. The Dow dropped 508 points, a 22.6% crash in a single day, the largest in history, and nobody could explain it. Not the economists, not the traders, not even the regulators. Because the cause wasn't a war or an oil shock or bad earnings. It was code, cold, logical, and blind. To understand just how destructive this innovation was, imagine a portfolio worth $100 million. When prices fell by 5%, the program sold a chunk to limit losses. Then prices fell more, triggering more sales. each fund trying to save itself, but collectively, they were burning the entire market down. Portfolio insurance wasn't insurance at all. It was gasoline. As one trader described it later, it wasn't human panic this time. It was the machines panicking for us. By noon, the New York Stock Exchange was on the verge of shutting down. Market makers, the people who were supposed to keep trades flowing, stepped away. They couldn't absorb the volume. There were only sellers left. It was a market without a pulse. The carnage rippled across the world. London, Tokyo, Sydney, all crashed in sympathy. In a single day, $1.7 trillion in global wealth vanished. For ordinary people, it meant retirement funds wipe out, life savings erased, businesses ruined overnight. When trading finally stopped, the market didn't recover because of human wisdom or government intervention. It stopped because there were no sellers left. The programs had finished executing. The machine had exhausted itself. In the aftermath, regulators scrambled to find answers. They blamed program trading and rushed to install circuit breakers, automatic pauses that would halt trading if prices fell too quickly. The goal was simple: never again. But history doesn't listen to good intentions. Because the real problem wasn't just program trading. It was the belief that technology could control risk. That you could reduce human emotion, fear, greed, panic to lines of code. But in doing so, Wall Street had built something far more dangerous, a system that could amplify panic faster than any human ever could. Portfolio insurance died in name, but not in spirit. Its DNA lived on, embedded in every algorithm, every automated strategy, every smart financial product that promised safety. In 1987, it was called portfolio insurance. Today, we call it algorithmic trading, passive investing, ETFs. The labels changed, the logic didn't. And as the 1990s rolled in, a new generation of traders began to trust the machines again. They thought they'd learned from the past. They hadn't, because what came next would make even empires tremble. For a while, it looked like Wall Street had learned its lesson. The 1990s brought new technology, more regulation, and the rise of a generation that believed computers could never cause another crash. Portfolio insurance was dead. The system was safe. At least, that's what everyone thought. Then, in May 2010, the ghosts of 1987 returned. This time, faster. It was a quiet Thursday afternoon. The economy was still fragile after the 2008 financial crisis. Markets were jittery but stable. And then, at 2:32 p.m., something unthinkable happened. In a matter of 5 minutes, the Dow Jones plunged nearly 1,000 points, almost 10%. Blue-chip stocks like Procter & Gamble and Accenture briefly traded for a single cent. Hundreds of billions of dollars vanished, and then, almost as quickly, reappeared. By 3 o'clock p.m., prices had rebounded. The flash crash was over. But the message was clear. The machines were back in control. Regulators were baffled. There was no news, no catalyst. Just a chain reaction triggered by algorithms reacting to other algorithms. It was portfolio insurance all over again. Only now the feedback loop moved at the speed of light. What took hours in 1987 now happened in seconds. High-frequency traders, the new titans of Wall Street, were fighting microsecond battles for profit. Their algorithms analyze market data millions of times per second, reacting to changes faster than any human could even blink. But when volatility hit, those same systems did what they were programmed to do: run. As prices fell, liquidity evaporated. Market makers pulled out. Buyers disappeared. The cascade was instant, a digital stampede. And once again, it wasn't fear or greed driving the market. It was code. One US regulator later admitted, no one was in charge. It was just algorithms trading with each other until it all broke. If 1987 was the age of the first machine, 2010 was the rise of the super machine. And by 2020, that machine had grown into something even more massive. When COVID-19 hit in March 2020, global markets imploded. The S&P 500 dropped nearly 35% in weeks, the fastest bear market in history. And once again, it wasn't just fear driving the collapse. It was structure. Investors rushed to sell ETFs and index funds. Those funds, in turn, had to sell their underlying stocks to meet redemptions. The same feedback loop from 1987, but multiplied by trillions. Portfolio insurance 2.0, hiding in plain sight. Even supposedly safe bond ETFs broke. They traded at massive discounts because no one wanted to buy. Liquidity, the lifeblood of markets, disappeared. The financial system didn't collapse only because the Federal Reserve stepped in with trillions in emergency liquidity. But that rescue came at a cost. It taught investors the wrong lesson, that no matter how bad things get, someone will always save them. And that's how fragility grows, hidden under the illusion of safety. The flash crash was a warning. The COVID crash was a second warning. Both revealed the same truth. The modern market isn't run by humans anymore. It's run by algorithms, ETFs, pumps, and passive flows, all reacting automatically, without thought or judgment. Each time, regulators claimed they had fixed the system. Each time, the machine grew stronger. In 1987, a few $1 billion in automated selling nearly broke the world. By 2020, over $15 trillion were locked into passive, automated investment vehicles, all built on the same dangerous logic. The market has become a mirror, reflecting our belief that machines make us safe. But every crash whispers the same warning. They don't make us safe. They just make us faster. And the next time the feedback loop starts, it won't take hours or minutes. It will take seconds. Because the machine doesn't care about you. It doesn't care about value, or logic, or fairness. It only follows its programming. And when that programming says sell, it will. And just like in 1987, the world will look for someone to blame, not realizing the real culprit isn't a person, but a system we all built together. Because centuries later, the same mistake would return, under a different name. Fast forward to 2025. The financial world is unrecognizable, at least on the surface. The trading pits are gone, the shouting brokers, the ringing phones, the chaos, all replaced by silent data centers filled with servers and blinking lights. But underneath, the same story is playing out again. Only this time, it's bigger. The old portfolio insurance programs are long gone, but their spirit, their logic, lives on inside nearly every financial product today. Only the names have changed. Algorithmic trading, passive investing, ETFs, index funds, quant models. Together, they've created a system that's faster, more efficient, and far more dangerous than anything in 1987. Let's start with algorithmic trading. Back then, computers controlled about 10% of daily trading volume. Today, they account for 70%. Every second, millions of micro decisions: buy, sell, hedge, cancel, all executed by lines of code written by people who no longer understand what their own creations are doing. Algorithms don't think, they react. If volatility spikes, they sell. If momentum reverses, they sell. If liquidity dries up, they vanish in microseconds. The result, a market that looks calm on the surface, until it doesn't, because all it takes is one tiny spark, one mispriced order, one bad headline, one geopolitical surprise, and every algorithm reacts at once. Just like 1987, just faster. But that's only half the story. The real danger, the silent killer, isn't the algorithms, it's passive investing. ETFs, or exchange-traded funds, have become the default way to invest. They promise safety, diversification, simplicity. You don't pick stocks, you just buy the market. And everyone does it. Individuals, pensions, governments, corporations. Over $15 trillion now sits in these funds, all tracking the same indexes, all moving in the same direction. Sounds safe, right? Except it's not. When you buy an ETF, you're not buying actual stocks. You're buying a claim on them, a derivative of ownership. The ETF itself holds the real shares. And when investors sell ETF units, the fund must sell those underlying stocks to meet redemptions. In normal times, that works fine. But in a panic, when everyone sells at once, the ETF becomes a feedback loop. Selling causes prices to fall, which triggers more selling, which causes more price declines, until liquidity disappears entirely. It's portfolio insurance all over again, dressed up as modern investing. Here's the illusion. ETFs are marketed as liquid. You can buy and sell them instantly. But their liquidity is an illusion because it depends on buyers being there when you want to sell. In a crisis, when everyone wants out, there are no buyers. Just a crowd of investors all rushing for the same tiny exit. We've seen it before. In 2020, even bond ETFs, supposedly the safest, broke. They traded at deep discounts because no one wanted to buy. The illusion of safety shattered. Now apply that same mechanism to the entire stock market. Every pension fund, every retirement account, every index strategy, all built on the same promise. You'll be fine as long as you stay in. But when the machine starts selling, staying in won't be a choice. Your fund will sell automatically, mechanically, without emotion, because that's what it's programmed to do. When that happens, who's left to buy? Let's line it up side by side. 1987 portfolio. Insurance sold automatically when prices fell. Programs followed fixed rules. No human oversight. Liquidity vanished because market makers couldn't absorb volume. Crash unfolded in one day, down 22.6%. 2025 ETFs sell underlying assets when investors redeem. Algorithms trade in microseconds. No human judgment. Liquidity will vanish because ETFs concentrate risk. The next crash could happen in hours, down 30 to 40%. Different names, same logic. And this time, the system is too large to stop. Circuit breakers, the fail-safes regulators installed after 1987, are designed for human speed. They pause trading for 15 minutes when prices fall too fast. But what happens when the crash unfolds? In 15 seconds. When algorithms execute millions of trades before the first circuit breaker even trips? The regulators are playing checkers. The machines are playing quantum chess. That's the real danger. Not fraud, not greed, not corruption. Automation. A market that's become so efficient. It's fragile, so optimized, it's uncontrollable. Every investor today, from Wall Street institutions to small retail traders, is part of this machine. Most don't even realize it. Your 401k, your retirement fund, your safe index investment. They're all gears in a system that can and will turn against itself. Because when the structure is designed to amplify moves, not stabilize them, a small ripple becomes a tidal wave. And history shows what happens next. The last time this structure failed, it took down markets for a generation. This time, the damage won't just be financial. It'll be psychological. A loss of trust in the idea that markets always recover. Because what's happening now isn't new. It's the final chapter, written all over again. History doesn't repeat, it evolves. And in 2025, it's evolved into something that doesn't even need us anymore. A self-driving market. A machine so complex that no single human can explain how it truly works. Yet it runs the world. Our retirements, our savings, our future. The irony is brutal. The systems built to protect us, diversification, automation, passive investing, now hold the power to destroy us faster than ever. We've replaced human panic with machine precision. But panic is at least emotional. Machines don't panic, they execute. When the next crash comes, and it will, it won't feel like 1987 or 2008. There won't be screaming traders or breaking news. Just silence, screens flickering red, liquidity vanishing at the speed of light, portfolios erased before the coffee gets cold. And as headlines scream unprecedented, the truth will be the opposite. It was always precedent. We just didn't want to see it. Because the danger isn't the machine, it's our faith in it. We built a system we don't understand, then convinced ourselves it can't fail. That's not investing. That's religion. Worshipping efficiency while ignoring fragility. But here's the good news. Awareness is power. History only punishes those who refuse to learn. If you understand the structure, if you see the pattern, you don't have to be the victim of it. So ask yourself, when the machine starts selling, what will you do? Will you panic with it or stand apart and watch it break itself? If this story opened your eyes, don't just scroll away. Subscribe, share, and tell me in the comments what lesson you'll never forget, because history doesn't repeat, but it rhymes. And this rhyme is already being written.